We're about to close off the first trading week of this year, and if this week is something to go by, we know it could be a positive but a bumpy year ahead. It's great to have your company. Today is the 9th day of January. So why are we expecting a positive year ahead? Well, earnings season is about to kick off, and we are expecting US companies to guide for about 11% earnings growth ahead. US mining companies expected to see the most hot sauce, 17% earnings growth, but this year maybe bumpy because geopolitical tension, yes, it's back on the rise thanks to Trump, which is exactly why the markets fear and volatility gauge, the VIX that we track by Moomoo, just type in VIX, it's risen up off its 10 months low. And that's because overnight, US Pres Donald Trump basically said that he wants to raise military spending to 1.5 trillion US dollars in 2027. And that's far above the current budget levels. He also said other things like he's not really happy with China planning to be a superpower. And again, remember, this is just days after he came out basically suggesting he wants to take over Greenland. Surprise, surprise. So across the week, we've just got to pause and have a quick reflection. The S&P 500 has had a positive week. It's up by about 0.1, or rather, it's up by about 1%. And it's hit a historical record all-time high. So too did the Russell 2000. The Russell 2000 up by the most this week out of the key indices. It's up 4%, but it's held at that brand new historical record high overnight. Down under, the Aussie share market not doing as good. In fact, it's in the red, slightly down this week, 0.1% lower from Monday to Thursday. Hong Kong's Hang Seng is down the most, about 0.7%. We take a look at the key themes and stocks that you need to pay attention to in our weekly, so stay tuned to that later on. As for what you might be expecting today and what you should keep your eye on, well, defense-related investments should be on your radar, obviously, because Trump is calling upon an increase in spending in military. Commodity companies, I think that they'll probably be gaining a lot of attention as well, maybe some dip buying perhaps, particularly because we are seeing commodity metals being lower for the first time in quite a long time. So that means the price of aluminium, copper, gold, iron ore, nickel, all their prices are lower, and that's because the US dollar is up. But I think today may be a buying opportunity for commodity-related companies, and that's if you believe China's data next week will be positive and show signs that China is buying more of Australia's metals and that it will continue to do so. But overnight, history was made, and we saw Alphabet overtake Apple to become the second biggest company in the world. So this is a huge turnaround because remember, people, including myself, about 8 months ago, were talking about Google being on the nose. And that's because Google search dropped for the first time in history. But we all know Google parent Alphabet, they came out, they reinvented themselves very quickly. They invested heavily into their businesses. Google integrated AI, and they also doubled down into their own AI tools like Gemini, launching new version after new version, rivaling ChatGPT. Plus, we also have been speaking a lot about Google parent Alphabet selling their own AI chips known as tensor processing units, or TPUs, to companies like Meta. Now, this has become really an interesting hot topic of debate. Who is going to sell more AI chips? But something else that's really exciting for Google parent Alphabet is that they are also somewhat becoming a leader in driverless cars, and that's via Waymo. Waymo is growing into new markets, and they're of course planning to run 1 million robo taxis a week by the end of the year, and that's something that we've spoken about a bit. For more details on that, we put the link in the description below. But we think that you should be keeping your eye on Alphabet. It's on the verge of becoming the world's second company to have a market cap of over 4 trillion US dollars. But Alphabet will probably have to fight for the top position to take over Nvidia. Nvidia, the world's biggest company, it's got a market size of 4.5 trillion US dollars. But as we stand, the market is basically suggesting that Nvidia's got more share price growth ahead of it over the 12 months. So Nvidia's shares expected to jump 40% in 12 months. That's ahead of 71% gross profit growth for the year ahead and 64% revenue growth. Overnight, we also saw Nvidia called out as Bank of America's top picks for AI stocks. And they're basically saying that you should keep your eye on Nvidia. Nvidia, if you put it against Google, their shares haven't done as well as Google over the past 12 months. Nvidia's gained 32%. Last night they closed at $185. Now let's bring back in Google, parent Alphabet. Their share price growth not as expected to be as strong as Nvidia over the next 12 months. The market is saying, hey, on the back of their phenomenal run, you should only expect a share price gain of 5% over the next 12 months. However, that doesn't necessarily mean it's going to be the case. The market is saying Google will only rise 5%. That's because the market is expecting a flat to negative revenue growth across the next year. In fact, they're expecting revenue growth to fall 3%, but gross profits to grow 66%. Also worthwhile focusing on upgrades in this space. Google parent Alphabet upgraded overnight to overweight by Cantor. Share price target 370, but last night, remember, it closed well under that, $325. But as we said, Google has been ruling the roost in AI. It's definitely outperformed Nvidia. It's up about 70% in 12 months. As to what's ahead, everyone likes knowing what's ahead because future earnings growth drives share price growth. So lots of analysts are saying over the next couple of years, you cannot ignore this stock. Many are saying, yeah, hey, this is too cheap. You need to think about the long term, the next couple of years. Most are seeing the stock doubling by 2030 if they maintain their revenue growth rate and also if they maintain their cloud margins and they continue to grow out that business as well. Alphabet's AI could also, according to consensus, could add $3 trillion in market cap by 2030. And that's basically with Google yet again being touted as underrated in the AI industry. Also, do note that Alphabet and Nvidia, the powerhouses, they're the leaders in their own right. But Alphabet, you could say, is in the golden age, piercing into new growth, but so too is Nvidia, about to launch into new markets as well. So the question is for you, do you invest in both or do you pick one or do you buy an ETF? But remember this, that earnings growth drives share price growth. Earnings upgrades and surprises to the upside always drive share price growth. So who will overthrow the other? That's a question for you. Let's move on to other investments to watch now. Let's bring in Ford. Ford has announced overnight that they're going to launch driverless cars in 2 years, and maybe they will make a foray into robo-taxis and rival Tesla and Waymo. That's what they announced overnight. Ford is already testing fully autonomous Ford Rangers in WA here in Australia. And that's in conjunction with Fortescue Metals. So on the back of the announcement about going into the driverless sector, Ford shares surged 5%. Now, Ford also came out basically saying that their driverless technology is more advanced than Tesla. Their technology has also, I guess, got a pickup of late across the entire driverless technology sector for that matter of late, because regulation was somewhat relaxed. And that basically means that companies need to spend less money on compliance to essentially to get driverless cars on the road. So perhaps that's why Ford is jumping on this bandwagon, so to speak. Another thing to also think about is, remember of late, Ford has basically said that they're decoupling or de-emphasizing from what they were previously going to do in Europe. Plus, they're also more broadly going to focus on those specific EV lucrative segments. So that's something for you to consider, and that's probably what could drive share price growth ahead for this company. Their share price has seen a steady rise since April last year's lows. It's now up 70%. Overnight, investment bank Piper Sandler upgraded the stock as a buy, while other investment banks and analysts have also lifted their price targets for Ford. Let's move to Huntingdon. Huntingdon shares surged to a brand new record all-time high overnight after they put on 6%. But do note, if you are a chartist and looked at their chart, that they have slightly moved into overbought territory, basically suggesting there's been a huge rush of investors diving back into the stock. And that's obviously because Trump said that he's targeting a rise in military spending in the US, wanting them to increase their fiscal budget to $1.5 trillion. And Huntington could be touted as a key benefactor. Why is that? Well, it's a $15 billion US military shipbuilder. So they design and make nuclear ships and non-nuclear ships for the US Navy and also the US Coast Guard as well. So they've got a very big market share, and their shares, that's why they've risen extremely hard and strong and fast, up 100% in the past year. And Huntington and other defence contractors are also getting a lot of interest of late. Another thing to consider is that Trump is now, he's actually asking defence companies in the US, and he's signed an order basically forbidding US contractors to issue dividends and do buybacks until they're able to produce a superior product on time and budget. And then again, this basically goes back to the fact that Trump is really serious about potentially disrupting things maybe. So that's why you should be keeping your eye on this stock as well as other defense stock. This one, Huntington, has got a buy rating if you do have a look at Moomoo's platform, and there's 8 analysts that have it as a buy. Last but definitely not least, JPMorgan. That's the first of the big banks to report next week. And of course, it's the biggest by a market size and scale in the US. JPMorgan shares, their shares rose almost 1% overnight, and they are holding in record all-time high territory. And of course, they report quarterly earnings next week. The reason that you should be watching this company, a couple of reasons. So of late, they've been consistently beating earnings expectations, and that's why their shares keep on punching to new record all-time highs. And this is a phenomenon. It's been happening over the last couple of years. What is the market expecting? Well, just over $46 billion in revenue for the quarter. And we're also expecting, if you have a look at consensus or what the average analyst is expecting, they're expecting earnings growth or income growth of 31% for the year ahead. Also note, yesterday, JPMorgan announced that they're going to take over the Apple credit card business from Goldman Sachs. And that's been a year-long negotiation. Now, the Apple business is one of the largest co-branded programs with some $20 billion in balances. And JP and other capital investment banks also remember that they're probably going to benefit this year from what is expected to be a very hot year of upcoming IPOs. Some are calling it an IPO boom. So this is, I guess, one of the many investment banks that you should be watching alongside Goldman Sachs that have got a very strong presence in the US and here in Australia as well in raising capital, doing IPOs. But let's just pause on their shares. JPMorgan shares up 36% in the past year, and they've got a buy rating among analysts. Plenty to watch and consider.